Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some information. I'm going to talk about the business cycle. And there's some things that I'm going to talk about today that I may or may not. I'm trying to figure this out, but I'm going to throw it out there, let you guys chew on it, figure it out yourselves. And if you've got any answers, definitely put it in the comment section what you guys think. So one of the biggest things that I look at is I try to figure out where we are in the business cycle. And if we were to look at this, and I'll pull up the business cycle real quick, this is what the business cycle looks like. You've got your output in GDP, you've got time, and basically you go into recovery phase, expansion phase, and then you go through a recession. And it goes back and forth and cycles over and over in an upward growth trend. And your actual growth moves through this business cycle. Now, this cycle that we were going into, if we were to kind of just look real quick, I yanked up the new privately owned housing units. The real estate market is the same as the business cycle. So the real estate cycle and business cycle are one of the same things. And we're seeing, I want to preface this with, this is probably the hardest cycle to get right and understand, because what the government did, or I should say what the Federal Reserve did, is they pumped a bunch of money in the beginning of this during the 2020 COVID crash. And that's what this is here, this crash right there. But as you can see, we were going into an expansion phase. When an expansion phase is anything that goes above the average. The average is about 1.4 million units or so. So we were going into an expansion phase back in 2019, 2020, and then we had that crash, and then it came right back up because it was structural by nature. The housing shortage that we had. Now, what they did is they pumped a bunch of money into the system. And that money into the system isn't a genuine driver of, it doesn't, here, I'll go back and just go back to the real estate, the business cycle. This is the real estate cycle. The thing that paces this business cycle is the real estate cycle. The real estate cycle, when it goes into an expansion phase, it hires people. Usually unemployment drops because they get hired on to build more new homes, and there's all these tertiary jobs that are created around the housing market. And there's usually GDP expansion growth that is accompanied by that. The thing that they did this time, though, and is different than all these other cycles that we've seen in the housing market, is they pumped a bunch of money into the system in 2020, like a massive amount of money. And what happened there is that when that money came into the system, I'll just show you guys real quick what that is on long-term trends. They pumped that money in the system. You can see it in the M2 money supply. And it's right here. There's that big pump up that they had of the money supply that we've never seen in history. This pump in money supply is going to be seen in the consumer price index. The consumer price index will go to a level that is not organically driven by the housing market. So this pump that they did is going to push or pull interest rates to a level that the housing market cannot sustain. So they're going to push this interest rate up to a level where housing will eventually slow down. And that's what we've seen. Now, I wouldn't have necessarily guessed that right off the bat, because we've never seen this before in history, a M2 money supply go up that much, that quickly. And it's also not driven by the market. So what I'm seeing in some of these posts here, just to kind of show you guys what I'm looking at, is this is the price of real estate versus interest rates. And I'm trying to figure this out myself. I'm trying to figure out what kind of ramifications this is, because we've never seen it in history. We've never seen a pump of money of that amount into the system that quickly, and especially during an expansionary phase of real estate, which would essentially supercharge real estate if they were to do exactly what they did, which was do QE, hold interest rates down, and then pump all this money into the system and basically give it out. And what we're seeing here is the price of real estate versus the interest rate. We can see at the end of October of 2022 is out in no man's land. It's an anomaly. The question that people should be asking is, how is this anomaly here? How did it get out there? Why are we seeing this? What is the cause of this? And that's what I'm really trying to answer here. The cause that it's way out there, I think, is because the market didn't drive the interest rate to this level. It's a fictitious pumping of money that came from the Federal Reserve to put the interest rate at this level. And they were buying MBS and all these other things, and now they're reversing all of it. What this is telling me is that this is artificially, it's being manipulated or controlled to some extent. Because if you've got all these other data points of all these other years, and it basically follows this line here, why are we out in the middle of nowhere compared to all of history? Now, I know a couple of people are probably thinking, they're saying, well, this is an anomaly out here. This is definitely going to crash at 7%, and it should go all the way back down here. And, I think there is some truth that this is probably in no man's land and it needs to migrate somewhere. I don't know where or how this thing is going to migrate. People think that the interest rates are going to stay at 7%. I don't think that will be the case. I think interest rates will come down, but this could move to the left as well and come back to this, 4.5% interest rate somewhere in this range here or something. And I don't know what the necessary sustainable rate is versus price and where this all zeroes out. But one thing I will say is that we are looking at an anomaly here. Something is going on. And I don't know if it was done on purpose. It very well could have been. Because if housing is the driver, if it historically has been the driver of inflation, and we're going into an era where real estate, let's just say they pumped it to a level that the interest rates are too high, and it basically slows down the housing market. It will slow down the money in the system to some degree from that credit being expanded from houses. And I don't know if they did that on purpose. I don't know if this is just a happenstance by pumping that much money in the system and then having interest rates rise as fast as it did because of that artificial stimulus that was put in the system. And I don't know how this is necessarily going to migrate back. I don't think anyone knows, because we're going into uncharted territory that we haven't seen in history before. With the stimulus money, the interest rates just rocketing higher with that stimulus money. And historically, it's all been driven by the housing market, not by the stimulus money. So I do think that this will come on back. Now, this is going to throw a huge, gigantic wrench into everything if you think about it. Now, if this were to come back down and it goes left here as interest rates go down and this goes down with it a little bit, you're going to see a disinflationary or even a deflationary component of the consumer price index, inflation, from housing if this were to migrate back down to some level over here. But at the same time, you could have inflationary forces in commodities go ballistic. And I don't know if they're doing this on purpose, where they basically took the inflationary hit in housing, and I don't know if they're this coordinated or what, and that this will naturally migrate back to some, we'll call it, an interest rate level that is sustainable by the housing market, where we actually have people transacting. And what's weird is that if this is artificially driven over here, I'm going to go back. If this is artificially driven, I don't know if that can stop the business cycle from occurring naturally. The imbalances in the system still, they all still exist. And I don't necessarily know how this will impact the markets on a longer, medium to longer term time frame. I'm trying to figure this all out because they introduced something into the system that is very dynamic that we haven't seen before. And when you go out and you look at some of these numbers that I kind of want to share with as well. So here's, for instance, here's gasoline and diesel demand. It's exceeding pre-COVID levels in September. And the drivers of this business cycle, which is demographic driven. So usually when you go into home buying years, you have a bunch of people at a certain age looking for homes, having kids, spending more money than they were before, which is all inflationary. And I don't know if they can necessarily stop that. Because I mean, interest rates even going up to a certain level, it can obviously stop people from purchasing homes, but it won't stop the money velocity from kicking up. And we're seeing that money velocity kick up. We're seeing diesel demand kick up. We're seeing gasoline demand kick up worldwide and going out above the 5-year average range. And if you look, and why this is so important is if you look at some of these, this is the U.S. stocks versus bonds returns in 1926 to 2022. There's 3 distinct periods, and they were all at the beginning of a commodity bull market. 1969, 1931, and 2022. Those were all the beginning of commodity bull markets. But then you have to ask the question in 2022, is this because the stimulus? Is this throwing the right data at us? Is that, are we reading this correctly because there was stimulus money put into the system at this time? And I think it is accurate, but I also think it's going, the stimulus money is going to play, it's going to play trickery on people looking at the normal data. It's going to trick them into believing that this bull market is done before it necessarily is. And that is me speculating. I don't know that for a fact right there. I'm trying to figure this out. But we're seeing these 3 anomalies here, 31, 69, and 2022, and they were all at the beginning of a commodities bull market when these returns go like this. And we're seeing the demand remain resilient around the world for gasoline, for diesel, for all these different commodities. And that, to me, doesn't seem like we're in a recession. Now, what happens is when the housing starts go below the average and start to dive down, we've always seen recessions after that. That's kind of our leading indicator. And right now, the housing starts are definitely rolling over, and they're right above average or right on average. So is this a leading indicator stating that we're going to go into a recession? Every time we've kind of dived below the average, we've had recessions on these dark gray lines almost every single time after they've dived down. Now, what's going on over here is the demand for housing, is it there, but it's just not at this interest rate level? Or are we going to go into the end? This is going to be a cycle that ends where we end the cycle and come back down in a contraction and then head back real quick. That is something that I'm trying to figure out. And I don't know if anyone's going to figure that out necessarily. If the interest rate is the only factor that's holding this down, I think interest rates will come back to some more sustainable level after the stimulus kind of works its way through the system. And we'll see an inflation rate that is above average, but be at an elevated, level, and the demand will kick back up and the housing starts will move higher, much like the late 1990s, early 2000s, and then they lowered interest rates and gave a bunch of loans out. This here ended with a bunch of inventory in real estate. It had a ton of inventory. Problem is over here is we don't have a lot of inventory. It's like we just slammed on the brakes. Interest rates slammed on the brakes for the housing market and the real estate market. We're seeing the divergence of this data here, where it just slammed on the brakes, and it's like, I don't know what to do. We have low inventory numbers, and they are rising, I agree, but it's out kind of in the middle of nowhere. So I'm trying to figure out why that necessarily is. What is the cause of this? Why is it doing that? And the only thing that I can come up with is stimulus money pushing interest rates to a level that is not organically, paced by the housing market, which means we've never seen this in history before. But the question is, what is next? Do we come back to a sustainable level where interest rates come back down and the housing market starts moving volume and sales again? Now, if that is the case, if we go and the demand is still there and interest rates are just the only sole thing that's keeping this from, keeping the wheels from turning, so to speak, that doesn't mean that we'll necessarily go into a contraction. It means that we're still in an expansion phase and that we'll come back to some level that we start to expand again. We won't go into this large contraction phase. Or if we do, it's going to be shallow and light. And then when interest rates hit a certain level, we go back into the growth phase again. And I'd love to have everyone's comments. Go ahead and comment below and let me know what you think and where we are in this business cycle. And if I'm wrong and why I'm wrong. I'd really like to hear your guys' opinions. And what's so important about this is a lot of this depends on where we deploy money and accurately identifying what's going on. And if we look at this and we were to evaluate this, usually in a rising inflationary environment, we go through a cycle. We went through this cycle that was over here in the recovery phase where we had accelerating growth, and we went this way where tech stocks and all these other things did very well. Develop corporate bond spreads, intermediate treasuries, develop real estate, develop equities, all these equities type investments over here. We went into a rising inflationary period from that stimulus where inflation protected bonds, emerging bond spreads, gold, commodities, international real estate, and emerging equities. Then we went back, and are we going to this area where gold and commodities do real well? Or are we already over here where we already went through this cycle really fast? Difficult to say. I still think that we're somewhere in this upper portion. Now, I understand that if real estate is slowing down, which it is, and you've got the base effects. The base effects are the way that the CPI is calculated is that it calculates we'll say the index today versus the index a year ago. And then it looks at the difference, and that's your percent difference for your consumer price index percent gain. During March is the time frame where I think the base effect comes way up. So we could see a drastic slowing of inflation in March, the February, March, April timeframe of 2023, because that's when the base of that calculation is basically priced in. That's when things really started getting moving in 2020. They stopped moving in 2022 at that time frame. So we should be seeing a slowing of inflation for sure by that time frame. And so we see the slowing of inflation, and those numbers come back down. And I think that's when the interest rates will come back down. And then the question is, are we going to kick the housing starts back on at that time frame? That's the question. And if that kicks back on up in March-ish, April-ish time frame, or maybe slightly past that in 2023, then we'll be at a sustainable level, and the stimulus, we'll call it the large stimulus money, probably worked its way through the system. But there also, if you kind of look at that long-term trends, they've been pulling back on the M2 money supply quite dramatically. And they're what's happening here, and I don't know why they're doing this necessarily, but you can see this is dropping quite dramatically here. And there's a lag to this number here, and you're going to see inflation kind of roll over some and slowly come back down. But they're going to contract too much, and they are going to cause probably a recession at some point in the future. When that recession is, hard to say. It could be probably somewhere around the lines of late 2023, early 2024, or something like that. And what they I don't know, what they should be doing is not slowing this as rapid and increase this as rapid. It should be more stable, in my opinion. But we've got some things that are really, they're not being driven by the market. These are all being driven by the central bank, and I don't think they're going to get this right. I think they're going to mess this up. So that's what I've got out there. That's what I'm looking at, and that's what I saw when I saw this this visualization here, this picture. So that's what I've got for today, guys. Let me know what your opinions are. So what they're doing is they're playing with the money supply. They pumped all this money in the system, caused all this inflation. Interest rates went to a level that was unsustainable by what the market could provide. Housing's in this no man's land because interest rates and mortgage rates that pushed on up is not sustainable, I think, for the housing market where they're at today. You've got the base effect of how this is calculated in the consumer price index. And that consumer price index number will stay elevated, I think, till March of 2023. Then the number is going to collapse in that inflation number. And it's going to be a lot smaller, whatever that number is. But in the meantime, the Federal Reserve is monkeying around with the M2 money supply. They're pulling things out, they're pulling things back, and it's hard to say if the money that they're pulling out is going to have a substantial impact in the money that is circulating in the system versus money that is in financial assets that they put in there and are yanking back out. It gets very difficult to figure this out because it is now being controlled by humans and not the market. All of what people are seeing and what they see in these movements in interest rates and all that stuff, all of those signals are from a free market perspective, but these signals aren't being driven by the free market. They're being driven by an artificial pump. So when they see they see the inverted yield curve, is that a inverted yield curve driven by the free markets, where real estate, and basically what it is real estate has a credit expansion phase. The curve inverts because of that credit coming into the system. Then when we build too many homes, the inventory gets too large. Everything starts to uninvert. You get foreclosures, you get delinquencies, you get all this stuff in the system, and then credit gets destroyed and the interest rates, people start piling back into bonds and the curve normalizes. But that's driven by the free market. That's driven by demographics coming in, into home buying years and pushing this curve and manipulating that curve from the demographics. This time of what we did, which I haven't seen before, is we pumped the money full of a bunch of, we punched the system with a bunch of money. We pumped it. And now we're seeing the distortions in the market with that stimulus pumped money. And what becomes difficult then is when we come back down, is that demand still there when we get back to a certain interest rate level that the housing market kicks back on again? And that, I think that's the case, but we've never seen this before. So that's what I've got. That's the question I've got. And I hope maybe I'll bring someone on who might have a different, an opinion on it, see what their opinion is. But that's kind of what I'm thinking is going on in the markets. Haven't really heard too much about this. But everybody just kind of looks at their numbers and they don't really understand maybe why the numbers. They just say, whenever this curve inverts, we have a recession. It's like, well, yeah, but what's the reasoning behind the inversion of the curve? What's the reasoning that we have a recession? What is causing these things? when I look at it, it's always been demographic related, demographic driven through the real estate market. But this time here, it's not driven by the real estate market. I mean, it is and it isn't. Because the money that was pumped in the system and the control, the things that they did with the interest rates and how they controlled them, and they created a mess here. I'll just say that. They created a mess. And now I'm trying to figure out, how are they going to unwind this mess? That's all. So let me know what your opinions are. Put it in the comment section. Love to hear it. But that's me just kind of talking through what I'm looking at, kind of how I'm trying to figure this out. And if you guys have your opinions, please share them in the comment section. Love to hear them. But that's what I've got for today, guys. If you're interested, definitely sign up for the Platinum membership, finding-value.com. I go over a lot of commodity investments. That isn't broken, but we could see a cyclical, shorter-term pullback some point here in the future, based off of what they did in the system and how they're reacting to it. So that's really what I'm trying to figure out right now. I don't think it's on us immediately, but it could be in middle of 2023, later 2023 or something like that, given what they're doing with the M2 money supply, given what some of these are doing. But that could also be reversed quite quickly if interest rates were to pull back some to a more sustainable level that the housing market can be at. But that's what I've got for today. Hopefully you guys are having a good day. We'll catch you next time. This is Finding Value.